Good afternoon. We're at the beginning of 2022. Earnings season will be kicking off soon. What I'm going to run through here, we can apply to really every earnings season. It's something that we trade every quarter. We are options trading pilot. It's me and Guillermo. We do daily trades. And I'll get into that in a little bit, and I'll walk you through specifically kind of our basic points that we look at each trade, especially in earnings. So options trading pilot, we help people learn how to trade, how to invest in different investment strategies. We're at optionstradingpilot.com. So a lot of words here. It really just says this is for educational and informational purposes. What you trade is your responsibility. You need to know the risk. Options trading has risk. You can mitigate that risk by using different techniques like spreads or just buying covered calls and things like that, which are beyond the scope of this conversation. But the ultimate is you need to trade what you know and take responsibility for that, which is empowering to me. So I've been trading several decades now. My grandfather taught me how to trade stock options when I was 11, and I did that and then became a Series 7 broker when I was 18, and I've traded part-time and full-time, and now it's full-time with stock options since then. You're hearing some beeping in the background. We're in the middle of the trading day, but it's a slow 10 minutes or so. So I thought I'd knock this out. So let's look at a few ideas, and then I'll bring you into the real live platform to show you specifically what I'm talking about. So first, trade small, trade often. This is, at least for me, trading options is not about making one trade a year, all in, big gain, big loss, walk away. No, we trade 20, 30, 50 times, could be a day, just depending on how fast the market is moving and what kind of opportunities we see. So it's not uncommon to make $50, lose $50, and that would be a successful trade. We are not looking, and nor do we trade for home runs. So one thing that we do look at around earnings season is implied volatility range. Generally, if the IVR is over 20, it's something that will be selling credit, either naked credit on both sides in a straddle or strangle, and or in a spread, either a debit or credit bull put or a credit bear call. We'll get into a little bit of that. Expected move based on historical numbers. You can, with probability and statistics, there's an expected move. Now, does it have to be in the expected move? No. You know, there's 1, 2, 3 standard deviation moves. Some are normal, and then some could be outside that range as what you call an outlier move. So, but we'll look into that a little bit more. Option volume, the key is you might have a great stock you want to trade. It has options. If there's no volume, how do you know you're getting the best price? You need an active market, so you know that you're getting the best price at a fairly priced item. And that goes into bid and ask spreads. And then ultimately, you want to look at strike prices. If they have 20-point wide strike prices, maybe that's too much for you as a new trader. Maybe that's taking on too much risk. Maybe you want to go with 1 strike, 2.5, 5-point strikes. So that's what we try to look at as we're going through this. And then ultimately, again, it's probability is statistics. You want to look at deltas. Deltas tell you the expected move around a stock. So if you go in and buy a 20 delta, that gives you an idea that you have about a 20% chance of that strike being reached by that time of the stock option. We'll show you that a little bit later. Okay, so moving on from that, this is our website, Options Trading Pilot. We do a lot of stock option trading. We also do a lot of training for people, and we do have services. Every day we are trading. My partner and I, Guillermo, we trade every day, all day. And we have we do stocks, we do stock options. We also do premium trading. And premium includes options, futures, cryptos, commodities. We do a lot in there. So let's move into the platform. This week we have Wells Fargo as an example that's coming up. I'm going to probably be leaning a little bit bearish on the financial sector. I'm actually long-term, I'm very bullish on the financial sector, especially with rising interest rates. But I think the number of these stocks have really gone up a lot. You can see here, just from the beginning of the year, we're talking about 9 points. That's quite a big move. And I think that's really all, for the most part, is interest rates. Interest rates go up. Banks have a lot of money in reserves. That extra income they'll earn goes right to their bottom line. But I do think most of that's cooked in. But we'll see. This isn't about guessing where the market will be. This is more instructional. So let's look at some of the things we talked about. We talked about trade small, trade often. So you have to look at your portfolio and net liquidity. We'll get into that in a different video. Implied volatility rank, that's right here. So this is a Tastytrade, Tastyworks platform that I use. But you can get them in other platforms too, but I like Tasty the best. So IV rank is here, 23. Remember I said if it's over 20, generally will be sellers of premium, will get credit in. If it's less than 20, the mechanics say that we need to be buying, so it'll be more of a debit. I like to collect money more than I like to spend money up front anyway. There are pluses and minuses each, but that's generally the rule of thumb that we use. So expected move. So let's go down. Here's WFC. They have earnings coming January 14th, which is Friday. You can see here, let's look at the expected move in this, and they're not very much. You see the expected move right after earnings is around 2.2 points, or here's like 2.74, so $2.74 move, point move, which is pretty tight. If you're looking at a stock, you think it's only going to move 2 points, that really doesn't give you much wiggle room, and that's denoted by the brown marks here. You really have to be right on this trade. If I was going to, I'll get back to that. Unexpected move, that's your expected move. So we're sitting at 56 now. It's a plus or minus 2. If it's within that range, you probably will be okay. But there really is not any kind of volatility crush. You're looking at implied volatility around 37. It really does not decrease. What I like to see is implied volatility of 80, and then it drops down to 50. So even if I'm wrong, I can still be right in the trade, meaning right, I can make some money on the trade. This one, it looks like you're not only going to be right in the trade, you're going to have to be right directionally. And I don't like to have to pick a direction a lot of times when I'm trading. I like to trade both sides of the market. So we talked about option volume. We're live right now. Market's open, so you can see there is quite a bit of, this is volume here in this column. So lots and lots of activity. So good volume. My bid ask is tight. We're looking at 2 cents bid wide ask, 2-cent wide bid-ask spreads. That's really good. You get into things that are really wide, and it really is relative to the price. But if it's thinly traded, meaning there's not much volume, most likely the bid-ask will be wide, and you want to stay away from those. As far as strikes go, you can see it does have some dollar-wide strikes. Here's a 0.5 point strike. Here's a 1 strike. So it does meet some of that criteria that we talked about. Now, one other thing is a delta. Here's a delta. You have deltas both on the call side, and you have delta on the put side. And remember, that's the percent chance. You know, this is forward looking, so it's nothing is guaranteed, but this is your percent chance based on historical numbers that, like, say 59 will be breached by January 21st. It's about a 19% chance, give or take. So let's say, let's put it all together now. So we have, I want to trade, well, let's look at JP Morgan. Maybe that'll be a little bit more exciting. Probably not. But, okay, so JP Morgan, $167 stock. Earnings are on, again, on this Friday. It only has a 4.5% move. That is around 2.2%, 2.3% expected move. That's really tight. So you really have to be right on this trade. Now, going into this, my bias is to the downside. These stocks have done extremely well since the beginning of the year. Interest rates have taken off. The stock has done very well. What is it going to take for earnings that the market doesn't already know from JP Morgan? My guess is there isn't anything much out there. They'll probably meet their numbers. They might even exceed their numbers, but are they going to exceed expectations? That I don't know. With a 2-point move, 2.5 or 4.5 move, 2% move, you're going to have to really be right on this trade to win it. So as an example, IB rank is 29, so I'll be selling credit. Of course, there's a lot of volume. Bid-ask, again, just a couple pennies. So let's say if I'm very bearish on the trade, I would sell at 170. This is for January, just for earnings. We have different rules for non-earnings times. As far as how many days to expiration, this only has 10 days to expiration. But what we're generally hoping on these types of trades is you get a volatility crush. Since you're not getting that, we could probably be more mechanical, move out to around the 45-day, which would be February. But let's say I still am bearish on the trade. So trading at 167. Right now, I could do probability of profit is 74%. I could sell the 175 and buy the 180. This gives me a max profit of, let's say, 100, max loss of 400. The buying power to do this is around 400. If you take the max profit over the buying power, it's about 25%. So it's not a bad, and you know, with the pop or probability of profit of 74%, it's not a bad trade. Mechanically, it's not a bad trade. What are the chances of JP Morgan this getting breached? Well, there's a 28% chance that 175 would be breached, you know, according to this delta. So, you know, you take the trade how you want to. If you're bullish on the trade, you could come in here and say, well, I'm bullish on, I think there's a lot more room to run. Again, because it's an IV rank, you want to be selling credit. So you could go to 160 and sell the 155. Max profit and gain are about the same because you're at the same delta strikes away, and your probability of profit is fairly similar as well. So now what you probably would not do, those are defined risk trades. What you would probably not do in this case is sell on both sides. And I generally like to do this. But let's say the deltas are not that where I want them to be. But say you're going to sell a 155 put for 17 delta. You're going to sell a 180 call, 17 delta. So it's delta neutral on both sides. You'll collect $2.38 in premium, a pop of 68. Your max loss is unlimited. And then you see your max profit here versus your buying power is about 1 to 10. So this trade is getting, it's a little bit too much risk for the reward. And remember, now coming into February, the expected move is 8 points. So do I really want to trade something that 8 points is not very much on JP Morgan at 167? I have to be right on this trade where it will actually stay within that expected move. If I get an outlier move, it only happened on one side, but if I get an outlier move, let's say the stock is 167, it drops down to easily 150. Now I'm losing money on the 155 put that I sold. So then I'd have to go in and aggressively move this down to try to recover some of the loss you've made here. If it recovers, now you're getting tighter. So it's just, and these are unlimited, well, theoretically unlimited losses. It can go from 160 down to 0. That's where the theoretical unlimited comes in. So anyway, those are some ideas how to trade around earnings. Know your risk. Look at the things like we talked about. Trade small, trade often. Look at the implied volatility rank. Look at the expected move for the period that you're trading at. Look at the option volume. Look at the strikes. And again, I'll probably, well, as important, if not one of the most key things for me is looking at delta and knowing what you're doing and where you're trading. All right, happy trading.